My personal investment strategy right now is that I think silver could easily go to $100, $200 for the next year or so. I'm serious. And gold go a lot higher as well, of course, but silver outpaced gold. But in this particular surge that I think we're on the cusp of triggering, like I said, get up to that 34.90 on momentum, it's going to break out. And you get up to 35, you're back to a triple top. It's a hit a top. Silver never tops, even with double tops, much less triple tops. That's a launch pad. But when you go through that level and touch 36 for all the price chart guys, they know they got a breakout then. I think that next move will likely carry you up into the 60s to 70s zone. I'm not going to be any more precise than that. But I think $50 won't even be a pause point.
Silver prices have been trading sideways and choppy for the past 5 weeks, suggesting a degree of complacency or even some exhaustion among the silver bulls. Gold's record run has left silver behind, and although the white metal hasn't caught up as quickly as many investors had expected, the price ratio between the two metals has held firm near historical highs. As a result, silver faces a global deficit for the 5th consecutive year. That suggests silver is still undervalued. Renowned expert MichaelOliver presents a compelling case for a coming bull market in silver that will obliterate previous all-time highs. When asked about previous all-time highs near $50 in 1980 and 2011, Oliver dismisses them as irrelevant artificial spikes. He believes silver is poised to blow past those levels, predicting it could reach 100 to 200 in the next year or so. However, in 2026, when global growth is expected to return, demand for silver is likely to rise to approximately 1.23 billion ounces. The problem is that supply may not be able to keep up with the demand, exacerbating the global silver deficit and potentially driving silver prices above the $40 to $50 mark. Based on his belief, Oliver notes silver is historically undervalued, currently at just 1.01% of gold's price. He states that the 2% norm would effectively double silver's value relative to gold. As far as markets are concerned, Oliver emphasizes silver only outperforms gold during strong uptrends, not declines. He highlights a downtrend in miners' performance versus gold since 2020. According to him, a breakout could lead to miners surging higher in late-stage bull markets. One of the silver miners' primary ETFs, the Global X Silver Miners ETF, increased by about 33% in the same timeframe. Additionally, when examining major silver miners such as Pan American Silver Corporation, PAAS, it has only increased by about 14% year-to-date, and Hecla Mining Company is essentially flat for the year. Before we dive into MichaelOliver's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
First off, the silver versus gold situation is, I think, essentially that chart too, going back about 50 years. If every year you made a note of what was the highest spread reading of silver versus gold, and the way we define the spread is we simply divide silver price into an ounce of gold price, and we get a percent. And you'll find over the last 50 plus years that 21 of those 50 years, silver's at least at some point during the year traded 2% of the price of gold. Well, right now we're 1.01% of the price of gold. So historically, we're very low. We've been lower, but this is very low for silver in relation to gold. Everybody knows that. Okay. When we technically analyze whether there's the potential to go back up to that, even just the normal 2%. It's not even asking a lot. You're asking for routine recovery to a normal level. Well, that's a doubling in the current valuation of silver to gold. Are there technicals that indicate to us that spread, analyzing the spread technically, is ready for an upturn and a surge? And we see them. We've not broken through them yet. Right now, silver, like I said, is 1.01. Divide an ounce into an ounce, as of today, as we're talking. Okay. If you get up to 1.1% price of gold, so move up 0.1%, okay, that spread is going to break out on our work over a first level of breakout. And if you ever clear 1.32%, you can make a note of this if you want, 1.32, I think you'll gush up to 2%, meaning just go to the norm. Well, heck, that process involves the doubling of current valuation of silver to gold. Now, whenever silver outperforms gold, it's never in a downtrend on both markets. In other words, when silver outperforms gold, it's because it's going up more than gold. It's never the case that silver outperforms gold because gold goes down more. You know what I mean? So the spread breaking out to the upside is also affirming net price upside in both markets. And I think we're on the cusp of that. And I also sent you a chart of the gold and silver miners versus gold. And that is a very clear spread chart. It goes back to 2020. And why did I go back there? Well, if you'll recall, that surge that occurred from late 2019 to 2020 was not only a price surge for all the metals and the miners, but it was a relative performance surge by the miners, where miners beat the pants off gold during that 6 or so months of that surge into mid-2020. Well, if you go to the peak of that rally, which is what this spread chart shows, you'll see it's a staircasing decline in the relative performance of the gold miners versus gold. There's a structure on that chart. If you treated it as a price chart, which in effect it is, it's price versus price. There's a downtrend structure and there's a horizontal structure, such that right now you're nudging up toward that level. In fact, that chart is as of last week's close. You're stronger than what that chart shows. You're not at the breakout level, but that breakout level is so well definable that when you break through it, expect miners to gush on the upside, not just in price, but in relative to the gold market, which they often do in bull trends, particularly later in bull trends. So we see both silver and the miners, which have been underperforming gold for the last several years in particular, since that 2020, 2021 period, they look ripe to turn up versus gold. And then there's a net price issue on silver too. And you mentioned that. I had a long-term oscillator that I showed. It's a 40-week average oscillator. Now, what is that? That means each week we take the weekly range and we plot it on an oscillator versus where is the 40-week average. 40-week average is about like a three-quarter average. It's about the same duration as a 200-day average. So it's a long-term average. And we want to know, where is this week's range in its relationship to that average? Is it above it or below it? In which case we plot the oscillator. That oscillator has a parallel channel on it that goes back to last May. And if you close this week out, and right now as we're talking, silver's been up to upper 33s. You get to the upper 34s, like 34.90 area again. Remember, it's peaked twice above 35, October of last year and March of this year. You get back up to the high 34s again, that spread's going to, not the spread, that momentum chart's going to break out. Meaning momentum says, I'm going for it. Meaning go for what? A triple top breakout in price. And I'm sure that whenever you go to 36, the price chart guys are going to say, well, I guess we were wrong. It's not a top. That's a triple top breakout. 235 peaks, and you go to 36. The point and figure guys will get all excited. I think it's going to happen. I think this rally is for real. You add $1 to about where today's high is, and it is for real. We're going to surge. And that's a net price acceleration sign for silver, which I bet will correspond to a relative performance shift by silver as well. My personal investment strategy right now is that I think silver could easily go to $100, $200 for the next year or so. I'm serious. And gold go a lot higher as well, of course, but silver outpaced gold. But in this particular surge that I think we're on the cusp of triggering, like I said, get up to that 34.90 on momentum, it's going to break out. And you get up to 35, you're back to a triple top. It's a hit a top. Silver never tops, even with double tops, much less triple tops. That's a launch pad. But when you go through that level and touch 36 for all the price chart guys, they know they got a breakout then. I think that next move will likely carry you up into the 60s to 70 zone. I'm not going to be any more precise than that. But I think $50 won't even be a pause point. In other words, I think you're going to get a quantum leap here up out of this history of silver. And in other words, put it somewhere remotely where gold is. You know, gold's peak in 1980 was $850. Its peak in 2011 was $1,920. Okay, well, gold's gone way beyond those old highs, and silver's still capped below them. That's a joke. I don't reference those old highs as meaningful. It's a number that I suspect that when you take it out, a lot of people will say, gee, I better own some silver. Okay. And frankly, once they gush it for about 10 or 15 bucks, I might take some call profits. But that's what I think is likely to occur over the next handful of months, maybe a quarter or two.
Regarding gold miners, MichaelOliver notes that they've outperformed the S&P over 1, 2, and 25-year periods but remain underappreciated. He underscores a breakout forming in the GDX to gold spread chart, indicating a sharp upside move could follow. This, he argues, may be driven by money exiting a weakening stock market and flowing into miners amid stress in the bond market. The S&P 500 to gold ratio has clearly broken down below multi-year support, currently trading around 176 as of May 2025. This represents a decisive technical breakdown below the 11 and 12-year support level that had previously contained declines. In past bull markets, think 2001 to 2011 or the 1970s, the gold price didn't just spike, it ran for years, and gold mining equities rallied several 100% during those periods. According to Van Eck, investor attention to mining stocks is only just beginning to return. Retail is still largely absent. Institutional inflows have increased, but we haven't yet seen panic buying. That's a good thing. Let's get back to the interview.
I sent you the spread charts of that of gold, first of the gold and silver miners versus the stock market, and it goes back to 2020. And what I showed there in the spreads was that like GDX had been around 0.7% of the price of the S&P since 2022. Just bip, 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 bip. So in other words, for the last 3 years, frankly, you could have thrown a dart and if you could have bought GDX and made more money than the stock market. It's a coin toss. Now you've made a lot more because in the last 4 months, gold miners have blasted out strongly on a spread chart versus that so-so par performance action that they produced since 2022. But gold since 2022 had built this range, dividing its price into an S&P, and you get this spread chart that's basically going sideways. You broke out of it about 4 months ago. It exploded. And the point I made in that report is if you go back 2 years, forget the precise points, just May to May, okay? You go back 2 years to May 2023, and this is as of last week, so it's even higher now. Gold's up 62.3% since May of 2023 for 2 years. S&P's up 42%. Gold's beat it by 20% over the last 2 years. Okay, not a bad spread. Long gold, short the stock market, even though the stock market went up. If you go back just the last year, May of last year, say, well, okay, where's gold versus S&P? Gold's up 30, this is as of Friday, 37.2% in the last year. S&P is up 12.9. Actually, it's not. It's lower than that now because of last week. So like triple over the last year, gold. Okay, so 2 years it's up more. 1 year it's up more. And I said, what the heck? Let's go back 25 years, quarter of a century. Gold's up 11-fold and S&P is up 4-fold. Oh, yeah, big ups and downs. Yeah, I admit it. But that's like a human investment lifetime almost, 25 years. Said, hey, I'm going to buy gold. What the heck? My granddad did. He told me I should own gold. So I bought it, okay? It just sits in my closet. And I've 11-fold gain versus a quadrupling in the S&P since 2000. Okay. So, I mean, throw a dart where you want. Yeah, you can find times when gold is down more than the S&P. But basically from, a year ago, 2 years ago, you probably go 5 years, it's the same story. Gold is beating the S&P. And yet you don't hear that on Fox Business News or on CNBC or et cetera. It's always cheering the stock market. Nobody's the bloody fact that gold is beating the pants off the stock market, and it does it consistently. Net price wise, just talking net price now, we know that we had a surge that peaked in mid 2020, or in the case of silver, early 2021. Then gold continued. It went into a range sideways just above 2,000, like 4 times to get above 2,000. They'd sell it, they'd sell it, they'd sell it. And it never would collapse, really. The biggest single drop you ever had in that 4-year period was 20%, and that was brief. Most of the range was like at a 15% range. If that were the stock market, nobody would care. But with gold, it was a disaster. Okay. Anyway, in March of last year, gold was coming up through 2,000 yet again. No big deal. It'd been there 3 or 4 times. So you sell it again, right? We said, no, this time it's different. It's going to blow. Silver was at 25 to 26 zone. We said it's going to blow to the upside. It shot up into 33, I think, by last May, and then ultimately 35. And the gold miners like GDX at that point in time was 31.5. Okay, right now we're trading just short of 50. Okay, so they had a net price breakout at that point. But on a relative basis, even despite that surge we saw in the gold miners over the last year, it still wasn't enough to break its spread out, which I've included in the charts I sent you. There's a GDX versus gold going back to 2020. There's a trend line that an idiot could draw, but it's on the spread chart. And that spread is a week old, so it's actually pushing up toward that trend line as we speak. That trend line is a multi-point, very clear structure. In other words, if this were a price chart, you'd say, ooh, I'm going to buy the breakout. Okay, I think we're on the cusp of that breakout, at which point the miners, while they've been strong, like over the last year, it was 31.5, and we said buy in March, we're resuming the bull trend, we said. Well, you've gone up a nice percent, right? And beat the heck out of the stock market. But it's going to beat gold at that point. And I think what that indicates, and this is what we've been arguing, is that it's highly likely that when the miners shift to the upside, it will be one of the causal factors will be money moving out of the stock market. Now, that spread has started to firm since late last year, the miners versus gold. You'll see on the chart, it's come up. It's not broken out yet, but it's risen. Well, what's happened in the stock market over those months? It dropped, okay. And the pullback we just had in the GDX versus the gold spread, minor little pullback last month, and it may not be in effect right now, frankly, was when the stock market rallied, okay. But when the money flows out of the stock market, it goes somewhere else. And most investors and large asset managers aren't prone to go buy silver futures or gold futures or even just raw bullion. They want to own stocks. And, some of these stocks put out good earnings and dividends, Newmont, for example. I think that flow is probably one of the factors that will cause the miners to reassert themselves on a spread basis versus gold, is simply the money moving out of this sinking battleship and moving over into this tiny little category. And it's a tiny category, you know that. It's a wet bar of soap issue if you suddenly get money moving into it. And I think that's what this chart in effect says, is that stock market break that is underway, we argue, despite the recent rally, will generate that. And there's other factors as well that are in play that have not been in play for a while. One is the T-bond market. We've been arguing for a couple of weeks. It looks like there's a T-bond crisis shaping up. And now suddenly I hear on the news today, oh my gosh, something's wrong over there. We've been warning something's wrong over there.
Silver's structural deficit and its lag behind gold could set the stage for an explosive catch-up, while gold miners remain a vastly overlooked asset class despite their long-term outperformance. As silver teeters on the edge of a breakout and shows signs of strength, are you positioned to benefit before mainstream attention floods in? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.